Ben Breitholtz, data scientist at Arbor Data. Ben, great to have you back on the show. I've been giving you credit this week because we heard the 10-year yield bottoming story first from you. So the question is, how do we figure out just how deep this selling goes?
Yeah, so what we've had really this past 2 weeks, has been a teardown in the uncertainty that exists due to Trump, trade wars, and so on. We have the potential for phase one, maybe a phase two of this trade deal. I know we had some hiccups with Trump kind of walking back on the concept of tearing down or pulling back some of these tariffs. But that uncertainty we can measure via his tweets and his retweets. And that is cratered really from the highest points it had reached in May. And amazingly, the movements in that uncertainty that exists within his actual Twitter activity has been a leading indicator for treasuries. So we've seen that. What?
Yeah, this is amazing. So you've got the chart here, Trumpian uncertainty. Steering U.S. 10-year yields, I mean, I don't know. Look, just from a glance, it looks too tight of a correlation to be a coincidence. But, I mean, is it really the tweets from our president that are driving the entire U.S. bond market?
I don't think, I mean, we can't go that far, but we can say that he is a beacon of this degree of uncertainty and the uncertainty that he is creating. So really, back in that chart, you can see, beginning in 2019, that series, the orange series, which again is measuring all the market-related events that Trump talks about. So is he talking about trade? Is he talking about geopolitics? He's talking about the S&P 500 or the Dow Jones Industrial Average. And when there's a degree of uncertainty in there, it's going to go higher. And when there's not, it's going to go lower. And again, in 2019, you can start to have this kind of leading ability. And we were not shocked to see yields continue to rise. The blue line, or kind of green line on this chart, has the 10-year note change on a monthly basis inverted or reversed. So lower means yields are actually going higher. And now we have the lowest degree of uncertainty related to these market impacting topics that we've really seen since May. Now, of course, Trump is putting all of his uncertainty into Democrats and the so-called witch hunt. And that's where all the fun is happening. Maybe it's getting him to move his head and move his focus, which has been actually oddly bullish for the equity markets and bearish for the treasury markets.
Now, of course, there's the possibility that maybe if he sees bad data or if he sees the markets coming off, then he starts to introduce language that's a little bit more uncertain. So, to your point here about it not being entirely, I mean, maybe there's also a reflection of what's happening in the data and how he communicates. So let's talk about some of the data, because another chart that you guys have is global slowdowns versus the 10-year yield moves. And this is pretty interesting. Tell me what you're looking at in this average that is, I guess, a compilation of leading economic indicators?
Yeah, so what we had done is we went back and we looked at, since 1970, all of the major global synchronized slowdowns that occurred. And so what we're looking for is the composite leading indicators for an economy. In this case, we're looking at over 35 of them to be below trend. So that's to be more than 85% of them below trend. When that happens, we'll trigger a global synchronized slowdown. And this chart nicely shows in the green line the average change of 10-year notes from the onset of that point. And it's been kind of uncanny how well the 10-year note yield, for the most part, has adhered to the typical average move. We get this drop of around 80, 90 basis points. And then roughly about 6 months into a global synchronized slowdown, we see relief and we see yields ultimately rise, which in this case, if we continue to follow this trajectory, that means yields on the 10-year space could go as high as 220 to 230 by year end.
So it looks like this is really the key one, okay? Because the red line here, if we bring it back up, is essentially just looking at, this is a basis point move on the 10-year yield note change. So if this then closes the gap to the average, then that means we're about, by my look, about 30 basis points away or so. You said 2.2, we're at 1.9, so that seems to line up to get us closing that gap. That assumes, of course, that the data doesn't change abruptly.
Right. And that's kind of the wrinkle. So we have a big week next week because we get CPI on Wednesday, and we've been indicating that the inflation releases are going to be that much more important going forward. CPI is expected to come in around 1.7% year over year on the headline, core around 2.4%. any type of movement back towards 2% is going to get the market excited. And that is where the sell-off can either be quickened or can be essentially abated or end. And my favorite indicator really of inflation expectations just had an interesting move in that if you look at the inflation swap cap floors market, so essentially the call versus put option premiums on CPI at 2%, that would be your strike price. If you're looking 30 years out on the 30-year contract, that just pushed above 50%, meaning that traders for the first time in a number of months are putting a better than 50% probability that headline inflation can run above 2%. Now that's for the next 30 years. It's a really long time, but that is, for me, a leading indicator that the markets are beginning to get a little bit more concerned about this inflation story.
Amazing, because we just heard that we're not getting any more rate hikes because inflation, is not near the target. But I guess we will watch and see. What does this mean, Ben, as it pertains to corporate bonds? I know that you've got a chart about real yields and zombie companies, and I think this is worth pointing out because at the top of the show, I was just looking at LQD versus TLT, and they both moved very quickly together in September, yet this move down in TLT has not really been accompanied by an investment grade weakness, a little bit, but just from eyeballing it from my perspective, it looked like there's still a little bit of gap. Do corporate bonds need to catch up? What do you see?
No. So the big story is what happens with real yields and how fast could they actually reapproach 1%. So the chart you have shows the 10-year real yield. It's the tips. Essentially, it's removing the inflation component, and that was right around 0%, and we've been rebounding since. But as that rises, the percentage of zombies that the market tolerates falls. So you can see as rates came down, the percentage of zombies moved from about 2 to 4% to as high as 18 to 19%. Now, a zombie essentially is a company that is unable to meet their interest expenses,
right?
And meaning that their EBIT to interest expense ratio is below 1. And you can see as rates got really low, we have this ability for these zombie walking dead to essentially continue to walk the streets. But as we get back towards 1%, that's really the break point. So how fast we get back there is what will determine the triple B story, the high yield story, and really corporates in general. If that doesn't happen, I mean, it's still a risk-on environment for investment grade and specifically for high yield.
So the speed at which it moves also matters, not just the elevation of the yield for zombie companies?
Absolutely. So what we've seen is volatility has appreciably come down in the Treasury market. So I know we had some big whipsaw moves that's going to turn some heads, but if you look at implied volatility for Treasuries, like the MOVE index, it's actually cratered from about a month or two ago, specifically when we had the highest degree of uncertainty. Now, that is important because as that volatility comes down, that is good for things like triple B corporates, high yield, and in particular, that is, I guess in the flip side, that's bad for the defensive names, and that's why we've seen some of the kind of coming out of low volatility. We've seen munis get damaged. High dividend stocks have not as of yet, but really this retreat in volatility, good for corporates, good for things like MBS and TIPS, bad for your defensive names because now these treasuries are not as scary to investors and they're not going to be going as quickly and running to things like munis or high dividend stocks or low volatility stocks.
Yeah. All right. We got to run. Ben Breitholtz, awesome work as always. Glad to have you here on another Friday. We did a hit on strangles earlier, and now we're talking zombie companies. It's like a week past Halloween. We can't get out of it. Ben Breitholtz joining us from Arbor Data rather. Really good stuff.